Hello and welcome to the first of our pre-budget specials. At the CNBC TV 18 India Business Leader Awards, the Finance Minister almost launched a budget curtain raiser by hinting that a relief package for the farm sector is merited. To discuss how such a relief package may be provided in a vote on account and what impact that may have on the economy and more importantly on the cost of capital, I'm joined by the former chief statistician and renowned economist, Dr. Pranab Sen, Suyash Chaudhary of IDFC Mutual Fund, Abhishek Upadhyay, the economist from ICICI Securities Primary Dealer, and Anant Narayanan, professor at the SP Jain Institute of Management and Research. But first, gentlemen, welcome. Let me start by first playing to you the key statements made by the Finance Minister regarding the upcoming vote on account and possibly an interim budget.
Fiscal prudence and fiscal discipline is something which gets rewarded in the larger interest of the economy. Of course, there could be unusual situations where you will have to fill the gaps in certain areas and you will have to increase the expenditure. But so far, we are now very close to completing 5 years of our first tenure, and we've stuck to that line. Now, when governments in the past have not stuck to it, we've seen the consequences of this on currency, the consequences of this on inflation, the consequences of this on investment, on the ratings, as also. And therefore, when we came to power, we inherited a fiscal deficit of about 4.5–4.6%. Last year was an unusual situation where we had the GST revenue only for 11 months and we had to really make the expenditure for the full 12 months, and therefore from 3.5 I intended coming down to 3.3 last year itself, but because of a 1 month absence of a tax revenue of the GST, we couldn't afford to do that. So that was an exceptional situation which I am sure the markets also understand, and therefore I certainly do understand the importance. And of course, deviations are possible only if extraordinary circumstances exist. And those are extraordinary circumstances which for analysts, for global players, for domestic players are relatively easier to understand.
Okay, so what the FM has said so far is that deviations from the fiscal deficit target is okay. The markets will understand if there are exceptional circumstances. So we asked him that question. Is the current situation in the farm sector amounting to an extraordinary circumstance that requires the breach of fiscal deficit? Listen to what he told us.
The farm sector, from the very data itself as it indicates, has been facing challenges. Now the challenges are of a nature that our farmers have hugely increased productivity and we've moved into a surplus era. Now that surplus era and the management of that surplus is constituting a broad challenge for us for the last several years. The prices have fallen. Even today, if you look at the last few months, food prices is something which have actually gone down in India, and that reflects on the kind of money that the farmers get. It entirely depends on what the existing situations are. And if we look at the big picture, there have been successes that we've seen in the last few years. There have also been challenges. And therefore, without getting into the specifics, because that would really be disclosing the mind into which we are working, some of those challenges really can't afford to wait. And therefore, obviously, there would be a necessity to address some of them. It's happened in the past, and therefore, we intend working within the parameters of the conventions as they exist.
Okay. Well, we've put all the statements that the Finance Minister made on the table. What is the implication for the upcoming vote on account and or interim budget? First to you, Anant, what is it? What's your key takeaway?
Well, my first takeaway was there is a clear intent from the Finance Ministry of treating the current situation as exceptional and therefore launching something by way of a scheme to address the rural distress. What form it takes, obviously, he didn't disclose and he can't disclose. I'm not even sure in what form he'll push it through the budget or in the current existing fiscal year itself. But clearly the intent that they want to do something extraordinary, I think came through. The question asked was very straightforward. Are you going to go through a normal vote on account or is there something else? And he didn't give a straight answer. So it does look like something is coming through. I think it has implications for the fact that we already have a fiscal deficit situation which is not looking good. We are going to mask it by using a whole means of, cute accounting standards. On top of that, if you add another fiscal slippage, it is going to put pressure on the macros. I think the debate we should have is, given inflation is so low and given the global context has interest rates coming down and nobody's really talking about a growth splurge or whatever, is this something that we can live with? Mm-hmm. Is it good? Is it a good time? Is it the best time possible to have a fiscal and a monetary splurge at this point in time? That's a good debate worth having. I'm not sure what the answer is.
Okay. Then let me throw that to the economist, to the economists we have. First up to you, Abhishek. Are you expecting a big fiscal deficit? And can the market live with it?
Well, Lata, so for FY19 RE, we are expecting government to print a deficit of 3.5%. As Anand mentioned, even this is optimistic and would be achieved only basis creative accounting, and it's likely that government will shift some expenditures off balance sheet. That would help them achieve the rather contrasting goals of not worsening the fiscal optics too much and still limiting the downside risk to growth in the run-up to elections. For next year, it's an interim budget, and our sense is that nothing stops the finance minister from announcing a big new scheme, but we doubt that there will be a large provision made for it. Spending in this budget will only be sought for the first 4 months. Refer to 2014 when Mr. Chidambaram presented a similar interim budget where he announced OROP, which was introduced for the first time. But the provision made in the budget was only 500 crores, and he made a comment that the final number may be different and sufficient provisions will be made over due course. But in the interim budget, a large provision was not done. We believe that a similar modus operandi could be at play this time, where all the announcements could be made, but sufficient provisions would not be there.
Okay.
So on that basis, we expect a 3.3 to 3.5% fiscal deficit in FY20.
20 as well. Okay, 3.3 to 3.5. Okay, we are also living with large state deficits where really the deficits are increasing. Dr. Sen, the slightly more tough question for you. What are you envisaging for the farm sector? If it is a waiver, it is not so much of a budget concern because the bill comes up later. The banks have to total up the amount, and then, by the time the presentation comes, it takes time. But clearly, that has already been announced by the other parties. So maybe something more has to come, like an income scheme. What is it? What is in your mind in terms of a practical offering?
Well, yeah, you're right. I mean, I don't think the waiver is a way out. The opposition has already taken that thunder. So I don't think that's going to happen. The most practical thing that they could do without any budgetary implications at the moment is to simply tell the banks that we are invoking force majeure. And so please roll over the agricultural debt for the next over the next 2 years. Okay. Okay? It's easy to do, but what it requires is an acceptance that the current state of being is the result of demonetization. Now, whether they will be willing to do that or they can sugarcoat it in some manner, that depends upon their spin doctors.
Okay. Well, Dr. Sen, let me persist. Yes, a loan waiver, what you're suggesting is similar to a loan waiver, and I don't know how much the government can do in terms of this kind of a rollover for banks that they don't own, that are majority owned by,
No. The banking rules provide for that, so that anytime you have a calamity, the banking rules kick in automatically and the loans are rolled over for a year and the government can extend it for 2-3 years.
That is strictly for only farm loans, right? That is for crop loans. For crop loans, that is allowed.
Only crop loans.
Okay. Usually that is done for crop loans when the revenue officer in the district declares it as a drought-affected area, right?
That's
correct. What the rules provide. Well, that may be a little difficult to defend at this point in time.
Well, not really. if you accept...
It's not drought affected. No, it is surplus affected.
It's not drought affected. No. But, the thing is, force majeure clauses exist everywhere.
All right. Okay,
right?
no.
So you can use a force majeure clause.
I'm assuming that legal problem can be, overcome, as you say. But my point is a little different. As the finance minister himself said at our function, agriculture is suffering from a surplus. So now if you're going to waive loans and you're going to give more money in some form of a basic income, basically you're trying to keep farmers where they are, and that will only exacerbate the surplus problem, isn't it? Is this the solution in the first place?
No. In fact, what worries me is to the finance minister's statement saying that farm production is in surplus. That is in fact not the case. What is the case? It's, in terms of a diagram, it will look the same, but what is the case is the fact that food demand has not risen in a country which continues to have food deprivation in the bulk of the population. So it's an incomes issue not for farmers only, but for the poor. Okay. So that's what's leading to your surplus.
Okay, I'll come back to you to ask what should be an ideal package. But let me come to the bond market guys, experts, to also check out, what will be the impact on cost of capital. See, the economy is also affected by the actual price of money. Anant, if indeed, they were to announce some kind of a farm package, and I think, you just can't talk in terms of 50,000, 40,000 crores. The dialogue has clearly shifted to something like 1 lakh crore at least, maybe 2 to 3 lakh crore. The scale has clearly shifted. If that were to happen, will there be a real rise in the cost of capital, a rate cut from RBI notwithstanding?
I think it will definitely be a cause of concern, and you are seeing that concern reflected in bond markets over the past few days. The rise up from 7.25% in the old 10-year bond to 7.60 now clearly reflects that worry. Look, I think what the bond market has been hearing is the following, that some kind of a package is inevitable, whether it's a universal basic income scheme or whether it's a compensatory scheme like you had in Telangana is a question mark. But anything between 0.5% to 1% of GDP, which could go as high as 2 lakh crores, looks like on the anvil.
Suyash, you're best placed to say what, from a bond market perspective, are the fears and how they may be masked also. I mean, if there is RBI capital that is resorted to.
Sulata, right off, the chief worry for now is, as everyone is suggesting, what kind of a package comes through, which in turn has two implications. One, to the fiscal deficit target, and two, how does it change RBI's response function, if at all. Our sense is, obviously in the run-up to such things, the numbers that come through on a gross basis sound, very large. But what could also come through is, some schemes getting subsumed into existing ones. So I think I read somewhere the Niti Aayog's point of view is that a lot of the existing subsidies, including fertilizer, power, and some other input costs, should be subsumed into a basic transfer scheme. Having said that, the fundamental problem of the bond market in India, and something we have highlighted before, is that irrespective the last 10 or 20 basis point of fiscal, on an average year, you are called upon to take almost 11 to 12 lakh crores of SLR supply, and local balance sheets are, not up to the job anymore. So this is a year where RBI has stepped in. I personally am not as harsh on the RBI's OMOs because, reserve money did need creating, and long-term repos may not have been the answer because next year also you will have 3 lakh crores of currency in circulation draw. So by temporary measures, RBI would have basically taken a forward view on FX or BOP, which probably may not have been prudent. Nevertheless, next year if OMOs are leaner in amount than what they are this year, we need FPIs to kick in. Or, this kind of bond supply will just lead to steeper yield curves. And the fundamental point about, long-term financing costs always being extremely elevated compared to potential IRR available on many infrastructure projects will always be the case. So you will see steeper yield curves. The shorter end may anchor better to where the repo rate and liquidity outlook is, but the longer end would respond to higher supply.